3. Trading with Confluence. Please take a moment to pause and read the disclaimer. Here is a mini course overview and the topics I will be covering. Part 1, Mastering Market Structure. Part 2, Supply and Demand Concepts. Part 3, Trade Execution and Liquidity. Part 4, Risk Management. Part 5, Psychology and Journaling for Trading. And Part 6, where we will be putting it all together. So you need to watch Part 2 before you watch Part 3. This is quite an important lesson and it's going to really set you up for Part 3. So if you haven't already done so, make sure you go and watch Part 2 now. Learning objectives. So there is quite a few learning objectives from this lesson. It's important to realize that everything is based on being foundational and for you to build on. So we're going to look at a number of areas. We're going to understand the role of liquidity in supply and demand trading and how to identify it. We're going to break down and understand multi-timeframe analysis. We're going to learn the different trading styles. We're going to learn about entering a trade via the different entry types. We're going to talk some trading and timing. We're going to understand the concept of confluences and how to identify them. We're going to know when not to trade and how to avoid common trading mistakes. We're going to look and understand components of trade management. And we're going to understand some trading realities. Liquidity. If you can't see it, you are it. Liquidity in supply and demand. Liquidity refers to the ease with which an asset can be bought or sold without affecting its price. In the Forex market, liquidity is provided by a network of liquidity providers including banks, financial institutions, and market makers. They facilitate market transactions by offering competitive bid and ask spreads and absorbing excess supply and demand. Banks and financial institutions act as primary liquidity providers in the interbank market, while market makers offer liquidity to retail traders and smaller institutions. The actions of liquidity providers can significantly impact the price and volatility of a currency pair. Understanding the behavior of liquidity providers can help traders anticipate market movements and identify potential trading opportunities. High liquidity can be beneficial for traders as it typically leads to tighter bid and ask spreads and better trade execution. And on that note, it's just important to realize that volatility is the measure of how drastically a market's price changes, and this is not to be confused with liquidity. Factors impacting liquidity. Market volatility. Low volatility can lead to reduced liquidity and wider bid and ask spreads. Economic news release. Major economic events such as central bank meetings or employment reports can cause sudden movements in the market. Market hours. Liquidity tends to be highest during the market hours that overlap, for example, the London and New York sessions. Trading volumes. High trading volumes indicate high liquidity, while low trading volumes suggest lower liquidity. Market depth. The number of orders and their sizes at different price levels can impact liquidity, as larger orders may take longer to fill. This can lead to inducement and price manipulation. How to identify it. Liquidity can be identified by looking for areas on a price chart where trading volume is high. These areas typically sit above or below supply and demand zones. Traders can identify areas of high liquidity by using technical indicators such as the volume indicator or by observing price action around key supply and demand zones. Identifying areas of high liquidity can be helpful in determining where to enter or exit a trade, as well as in managing risk by placing stop-loss orders in areas of low liquidity to avoid slippage. With all that said, we can simplify identifying liquidity to patterns such as equal highs and equal lows, trendline liquidity, buy-side liquidity, and sell-side liquidity. Liquidity patterns for Confluence. In order to provide a visual to the theory of the various liquidity types, I've provided some markups below for your information. Take some time to learn these and see can you identify them on a real chart. Tip: use the wicks. We can typically look for a minimum of 2 to 3 touches subject to the pattern you use. Liquidity patterns to avoid. You'll often see traders use liquidity patterns for entry into a trade. You might be familiar with the terms double tops or entering off the trend, and whilst they can work sometimes, in my experience they tend to fail more than they work, because like that, the market is looking to collect and take out the liquidity. Therefore, it is recommended to avoid entering a trade off of these patterns. Buy-side liquidity diagram example. Just to support my previous comments, I've marked up a theoretical example, and what you'll see is that the market pushed over the trend line, which we now call buy-side liquidity, to enter the extremities of a supply zone before selling off. I want you to jump onto TradingView and try and find this pattern. I think you'll be surprised just how many times you can find it and how many times you can see it. Multi-timeframe analysis. Always zoom out. Multiple-timeframe analysis. Multiple-timeframe analysis is a technical analysis used by traders to gain a comprehensive understanding of market trends and make informed trading decisions. MTA involves analyzing price data across different timeframes to identify trends, assess market sentiment, and determine entry and exit points. Why? Well, MTA helps to provide a complete picture of the market, and it can help to identify key levels of support and resistance, as well as potential areas of supply and demand. The higher timeframe charts can help determine the overall trend and market bias, while the lower timeframe charts can provide a more detailed information on price action and potentially entry and exit points. When using multiple timeframe analysis in conjunction with supply and demand trading, traders can identify probability trade setups based on the alignment of supply and demand zones across different timeframes. For example, if a strong demand zone is identified on a daily chart and the price is approaching that zone on the 4-hour chart with bullish price action, this may provide a good opportunity to enter a long position with a favourable risk to reward ratio. It is important to note that multiple timeframe analysis should not be used in isolation and should be combined with other technical analysis and risk management aspects to make informed trading decisions. Timeframe selection. The choice of timeframe depends on the individual trading style, goals, and preference. Long-term timeframes, daily and weekly, are ideal for identifying primary trends and establishing the overall picture. Intermediate timeframes, 1 hour, 4 hour, help confirm trend and define support and resistance levels and possible supply and demand zones. Shorter timeframes, 5-15 minutes, are useful for fine-tuning entries, managing trades, and identifying intraday reversals. We can look at a couple of timeframe combinations. We've got the 1, 5, and 30 minute, 5, 15, and 4 hour, and 1 hour, 4 hour, and daily. It's down to each trader to determine what time frame combination they want to use. Advantages of MTA: broader perspective, enhanced trend identification, valuable context, improved timing, reliable indicators, reduced false signals, informed decision making, comprehensive understanding, increased profitability. These are some of the advantages of using multiple timeframe analysis. Disadvantages of MTA: increased complexity, time consuming, conflicting signals, increased risk of overtrading, potential for analysis paralysis, information overload, difficulty in finding optimal setups, market noise. It's important to recognize that there is a number of disadvantages, and for a new and beginner trader, multiple timeframe analysis can be quite complex. So take your time, don't rush anything. The markets are going nowhere. Choosing what type of trader you want to be is really important. So I've got a couple of items that we're going to look at and help you to determine what type of trader you want to be. So on the left icons, we can see we've got trade style, alerts, hold time, analysis, and monitoring of trades. So if you were to be a scalper trader, you're going to be looking at several minutes to hours. Your alerts or trade signals for entry could be within minutes. Your hold time is possibly and more likely minutes. Your analysis is going to be undertaken on the 1 minute, 5 minute, and 15 minute charts. And in terms of monitoring trades, you're going to be extremely active. If you want to be a day trader, so you're looking at a time period of intraday, your alerts are going to be daily, hold time could be hours, time frame analysis will be on the 15, 1 minute, and 4 hour charts, and you're going to be an active type of trader. Swing trader, you're going to be medium term. You're going to be looking for weekly alerts. Your hold time could be days to weeks. Your charts are going to be 1 hour, 4 hour, and daily. And you are going to be periodically monitoring trades. And lastly, a position trader is a long-term style of holding. Your alerts for entry are possibly monthly to yearly. Your hold time could be months to years. You're going to be looking at the daily, weekly, and monthly charts. And the type of monitoring is really set and forget style type trading, which basically means you're going to be rarely on the charts once you're in position because of the length of time you're holding. Entering a trade, knowing how, more importantly, knowing when. Quick recap from lesson 2. Discount zones equal buying opportunities. Premium zones equal selling opportunities. Trade entry types. Trade entry types in Forex trading can be broadly classified into confirmation and aggressive entry. Confirmation entry involves waiting for a price action to confirm a zone's validity before entering a trade. This type of entry can offer a higher probability of success and is favored by conservative traders who want to see confirmation before entering a trade. Aggressive entry, on the other hand, involves entering a trade as soon as price reaches a supplier demand zone. This type of entry can offer a better risk to reward ratio, but carries a higher risk of failure if the zone is not properly validated. In supply and demand trading, both entry types can be used depending on the trader's risk tolerance and trading style. Aggressive entry can be used in strong trending markets where price may quickly move away from a zone, while confirmation entry can be used in ranging markets where price is showing indecision. Regardless of the entry type, proper position sizing and risk management are critical to long-term success in Forex trading. Risk aggressive entry. So here we can see a typical example of a risk entry pattern. So the positives with this is that it can be a set and forget style type of trading and the risk reward can be higher. However, there is some negatives. There is a higher risk for failure as too much volume can add risks to the trade when you're using an aggressive entry. Typically, price action should be weakening as it's approaching the zone and we would look for confirmation entry. And you can typically do this via top-down analysis. But if you are using an aggressive entry, just be mindful that there is a higher risk that the trade could fail. You could get swept. And again, just demonstrating real chart data using the exact same type of risk pattern. You can see here that we have identified a supply zone and we are using a risk entry approach and that the market taps us in before pushing to the upside. Confirmation entry. So this is a better approach to entering trades. However, it does require time and consistency to become successful with this method of trading. There is some positives where it adds confluence to your trade setup and you can look to take multiple confirmation trade entries to the overall trade setup. There is, of course, some negatives. This type of entry requires more attention to the market and it does require close supervision to manage the trade. And as you can see from the chart pattern, we look for a downward break of structure. So that is represented with DBOS. And here this signifies to us that the market shift is changing and becoming bullish. And in this instance, we would now look for the sell-off, hence confirmation entry. Again, using real chart data, we can see an aggressive entry zone was mitigated, whereby we are now looking for a confirmation entry. We can see a further DBOS, which lets us know that the market is pushing downwards. And again, this enables us to look for a selling opportunity. And as you can see, the market did trigger that confirmation entry before it completely sold off. Fractal approach. The fractal approach is a method of entering a trade using multiple timeframes to identify a potential trade setup. It involves analyzing the price of a higher time frame to identify the overall trend and key supply and demand levels. Then, a lower time frame is used to identify the specific entry point based on the setup in the higher time frame. The fractal approach allows traders to capture a larger price moves and reduce the risk of false signals by aligning the trade setup across multiple time frames and constantly looking for confirmation. It requires patience and discipline to wait for the alignment of confirmation across multiple time frames before entering a trade. Traders must be mindful of the potential risks of using multiple time frames, such as conflicting information and a delay in the execution of a trade. The fractal approach can be used in conjunction with supply and demand to increase the probability of a successful trade. Fractal, in simple terms, is looking for mirrored confirmation entries as you go through the lower timeframes. As you can see, we've got a 1 hour supply, a 15-minute supply, and we are looking for our entry on a 5-minute supply. Times to trade. The Forex market is open 24 hours a day, 5 days a week, providing ample opportunities to trade. The best times to trade are when there is high liquidity and volatility in the market, which tends to happen during overlapping trading sessions. The London session, which opens at 8 AM GMT, is considered to be the most active trading session, accounting for nearly 45% of the total daily trading volume. The New York session, which opens at 1 PM GMT, is also highly active, accounting for 35% of the total daily trading volume. The Tokyo session, which opens at 12 AM GMT, is considered the lower volume trading session, accounting for about 20% of the total daily trading volume. For day traders in Europe, the London and New York sessions would likely be the most suitable times to trade as they overlap with normal business hours. It's important to note that not all trading opportunities will present themselves during these times, and traders should always exercise caution and conduct proper analysis before entering any trades. Where to enter? There's a couple of ways you can enter a trade when you identify a supply or demand zone. I'm going to show you a couple of ways that we can look to do this. So the first one, we have a typical entry zone where we use our order block for entry and stop loss. Note, be mindful for liquidity resting above or below a zone. Has it been mitigated? If not, ensure space is allowed for this with a few pips above or below the zone following your due diligence for entry. It's hard to give it an exact number. You need to do this yourself. The second way of entering is where we would look to have the same type of entry, but instead of having our stop loss sitting on top of the order block, we would actually look to bring our stop loss to the last swing point. So in this example, we can see we brought our stop loss to the last swing high. Remember, if we are determining that it is a swing high, we are anticipating that this zone is protected and will not be broken in line with order flow. And finally, the last way of entering. If we've identified that there's a big buildup of liquidity either above or below our zone, we can look to put our entry typically at the top or the bottom of the order block. So in this instance, you would look to have your stop loss a couple of pips above or below, and again, this is down to your due diligence where this is going to be placed. Let's talk about a stop loss. Stop loss helps protect trading capital by preventing significant losses in volatile and unfavorable market conditions. Stop loss allows traders to define their risk before entering a trade, aiding in risk management and position sizing. Stop loss eliminates emotional decision making by providing a predefined exit strategy. Stop loss enforces trading discipline by sticking to predefined risk parameters and trade plans. A stop loss enables traders to maintain a favorable risk to reward ratio. Stop loss reduces psychological stress associated with trading. Stop loss orders can be automated, allowing for efficient trade execution. Implementing stop loss orders is crucial for responsible trading, protecting capital, defining risk, maintaining discipline, reducing stress, and ultimately leading to improved long-term trading success. And that's what this is all about. Stop loss and risk management are about growing and preserving your capital. We're not gamblers, and it's important to recognize this. Picking a profit target. Don't be greedy. Aim for swing highs or swing lows when you're typically looking for areas of profit. Aim for unmitigated supply and demand zones subject to your trade entry position. Consider market conditions and stick to your trading plan. Be realistic. So I have a couple of examples below that I'm going to show you now. The first example is a risk entry where the return was 28.2R. Very attractive and very lucrative. Of course, anybody who's trading wants to be hitting these type of trades all the time. However, the realities are when we look at a confirmation type entry, the risk to reward was 5.69, which is a lot more achievable, a lot more realistic, and a lot more manageable. When you're looking for constant risk entries, ultimately you're going to be taking higher risk trades, which ultimately, if you don't know what you're doing, leads to gambling. It's important that when you're trading, you're realistic. My rule of thumb is aim for a minimum risk to reward ratio of 1 to 4. So that means for every 100 euros I risk, I make 4. This will allow you to scale and grow your account over time. It's all about risk management, but equally being realistic with your trades. You're never going to hit 28.2R trade after trade after trade. It's just impossible. The odds are stacked against you. And I'm telling you right now, I'm being real with you, you won't do it. You'll see many influencers online that are posting that they're hitting 30, 40, 50, even some have posted 100 R2R trades. You may, in your entire lifetime, hit one trade like this, but to do it consistently, the way these social media influencers promote it, it's all rubbish. I'm telling you right now, they are absolutely not hitting those trades. Maybe on a backtest account, but in their real capital, or they're risking literally minimal money that it looks fantastic on paper, but the truth is they're making no money. Confluences. Creating a systematic approach. What are confluences? Confluences can be identified as a criteria item that needs to be achieved when combining a variety of trading requirements. It allows you to formulate a rationale and justify your decision. A confluence list can be used to increase the probability of a trade entry and a winning trade. After all, it's a game of odds, and you must do everything to increase them in your favor and gain your edge. Confluences are your system. You need to create a confluence checklist. What confluences can I take? To name a few, we have structure, imbalance, volume, pricing, timing, news, liquidity, and you can add some others to build your confluence list. When not to trade. There's always another trade. When not to trade. Trade criteria is not met during spread hours, insufficient market understanding, emotional instability, there's unfavorable market conditions, a lack of a trading plan, financial constraints, personal distractions, lack of confidence, overtrading. These are all key items that you need to factor to determine if you should or shouldn't be trading. If you're hitting any of these key items, you should not be trading. Trade management, an effective approach to trading. Trade management. Trade management is a crucial aspect of successful trading, involving strategies and actions taken after entering a trade to optimize the outcomes. Trade management can include setting clear objectives, position sizing, stop loss placement, trailing stop, profit taking, risk to reward assessment, monitoring and adjustments, and trade journaling. These are all key components of trade management. Trading realities. Straight talk. Multiple entries. It is generally advisable to avoid taking multiple entries in a single trade, as it can increase complexity and potentially lead to overexposure or conflicting positions. Taking multiple entries in a trade may increase the risk of overtrading and result in difficulties in managing and tracking multiple positions simultaneously. Therefore, it's not advised or recommended. Strategy failure. Every and any trading strategy must not be considered a holy grail. Every strategy can and does fail at some point. Supply and demand zones, while a popular strategy, are not foolproof and can fail to provide accurate predictions of price movements. Market conditions, unexpected news events, shifts in market sentiment can cause supply and demand zones to fail. Relying solely on supply and demand zones without considering other factors can result in suboptimal trading decisions and potential losses. It is essential to use robust risk management. This idea around smart money concepts being better than every other strategy is a bit misleading. SMC can be great if it's used smartly. But what does this mean? It means you need robust risk management and a rationale for taking your trade. Losing a trade. Firstly, it's okay to lose a trade. Embrace losing. It's part of the process. Losses are unavoidable even for experienced traders. Prioritize risk management over the outcome of individual trades. The goal is to survive. Win or learn. Treat your losses as buying experience in the market. View losing trades as valuable learning experiences that provide insights and opportunities for growth. Stop thinking in the now. Think long term. Adopting a long-term perspective and focusing on the overall profitability of a trading strategy rather than fixating on the individual trade outcomes. Stay consistent with trading plans and strategies, regardless of individual trade outcomes. Remember, the goal is to achieve a positive overall expectancy by managing risk, learning from losses, and staying disciplined in trading decisions. Conclusions and recap. Let's talk about it. Recap of the learning objectives. We can now understand the role of liquidity in supply and demand trading and how to identify it. We can break down and understand multi-timeframe analysis. We've learned the different trading styles. We've learned about entering a trade via the different entry types. We've learned about trading and timing. We now understand the concept of Confluence and how to identify them. We now know when not to trade and how to avoid common trading mistakes. We've learned how to understand components of trading management, and we've understood and spoke about some trading realities. Again, the whole idea around this lesson is that it is foundational based, and it is for you to further deep dive every single component within this mini series. Conclusion. It's okay to lose a trade. Understanding the behavior of liquidity providers can help traders anticipate market movements and identify potential trading opportunities. Multiple time frame analysis is a technical analysis used by traders to gain a comprehensive understanding of market trends to make informed trading decisions. The choice of time frame depends on individual trading styles, goals, and preferences. Trade entry types in forex trading can be broadly classified into confirmation and aggressive entry. The fractal approach allows traders to capture a large price move and reduce the risk of false signals by aligning the trade setup across multiple time frames, constantly looking for confirmation. For day traders in Europe, the London and New York sessions would likely be more suitable times to trade as they overlap with normal business hours. Confluences can be identified as a criteria item that needs to be achieved when combining a variety of trading requirements. It is generally advisable to avoid taking multiple entries in a single trade. Every and any trading strategy must not be considered a holy grail. Every strategy can and does fail at some point. Next steps. Homework time. Homework. Keep building on your study diary. Write out all of the liquidity structures identified in this lesson. Practice finding supply and demand zones on multiple time frames. Identify the various entry patterns from the zones you identify. Detail and build out your Confluence list. Then rewatch this lesson for further clarity and understanding. What's next? In the next lesson, we will look to really understand and detail the components of risk management. This is vital for every trader and investor, no matter what level you are at. References. Learning never stops. Thank you for watching. I hope you enjoyed this lesson. Don't forget to like, comment, and subscribe. I really appreciate your feedback, so please, if you have any comments, leave them down below.